Hi there, welcome to Nepi Invest. In this video, I'm going to be looking at the Appendix 4C for a company called Whisper. Now, I have been a shareholder of this company in the past, no longer am, and they're in the right sector, a very hot sector over the past few years. And the question is, will that sector remain hot over the next 5 years or so, particularly if interest rates start to rise? So they're a tech company, a SaaS company, and what they have is a cloud-based communications platform that brings the communication channels of a company together in one easily accessible space for their employees. So before we get into the Appendix 4C for the company, let's have a look at a few financial facts around the company. So their ticker code is WSP, which is a natural fit for a company called Whisper. Market cap of 388 million. Now, so most companies, I do look at the revenue and I look at revenue growth over time. For SaaS companies, they do have a metric called annual recurring revenue, and I do actually prefer to look at that. And annual recurring revenue is looking at the future potential revenue, while the revenue is looking at the past. So annual recurring revenue should be greater than revenue, and in this case it is. So that actually is a good sign. If it was less than revenue, that would be a potential bad sign. Now, most companies in the SaaS space on the Australian market are not profitable and not even operational cash flow positive. So they're all spending for growth. They're all thinking about the future and they want to grow. And that's not a bad thing. In fact, that's a good thing in my opinion. But at some point, they will have to think about providing value to their shareholders and they want to become profitable, because the only way you can value a company in the long term is if they are cash flow positive or have free cash flow or are profitable. So at some point, they're going to have to think about that. Now, when it comes to the price sales ratios, it is a metric or a ratio I do like to look at. And to calculate that, you do have to divide market cap by revenue. But for SaaS companies, I divide market cap by annual recurring revenue. Instead of market cap, you could use enterprise value, because a lot of these sort of companies have a fair bit of cash on hand and no debt. And actually, if you do that, I think Whisper has something like $40 million of cash on hand. You actually get a much better price to sales ratio. So for Whisper, you divide market cap by their annual recurring revenue, you get a price to sales ratio of 7.7. So what does that mean, 7.7? Now for SaaS companies, the magic number there is 10. Now this is not taking into account growth rates of the individual companies, which is actually very important. Now, why is 10 a magic number? Well, there's no reason behind that. It's just something I've seen in the past. That's when you see SaaS companies less than 10, that shows you there could be some value there. And when it's greater than 10, it's showing you that there could be some valuation stretch with those companies. But again, that's not taking growth rates into account. You could have a very quickly growing SaaS company with a PS ratio or price to sales ratio above 10 and actually could be good value. And on the flip side, a slowly growing SaaS company might have a price to sales ratio of 5, and that could be, you could arguably say, valuation of that company is stretched. So what is it for Whisper? With a price to sales ratio of 7.7, that might mean there's good value here, but we'll have to look at what the growth rate in their receipts is at the moment. Now, they did give us some numbers in this report. Now, over the previous corresponding period, annual recurring revenue grew by 20.3%, which is a fair good growth rate. And over the past quarter, they saw annual recurring revenue grow by 5.2%. But I prefer to look at cash receipts per quarter for their growth rates. So we'll have a look at that in a couple of slides. Before we look at the trend rate of cash receipts for Whisper, I just want to look at the cash flows from operating activities. And this is the first thing I go to when I see an Appendix 4C be released by a company. Now, there are two numbers I look for here. That's receipts from customers, and for Whisper, that's at 10.9 million. Now, in isolation, that means nothing again. We need to know the trend in cash receipts, and we'll look at that in the next slide. But more importantly, are they operational cash flow negative or positive? And for the quarter, Whisper was negative by 1.2 million. But I've mentioned before, that's very normal for these sort of companies. Most of them are operational cash flow negative because they are trying to spend for future growth. Now, another really important thing is how much cash they do have. And they began the quarter with 46 million and finished the quarter with 44 million. So a lot of cash on hand for future growth initiatives. And here is the receipts history for Whisper over the past 2 years of data. So I do like to have 2 years of data so we can have a good sample size, and we have that for Whisper, exactly 8 quarters of cash receipts history. Now the compound quarterly growth rate of receipts is at 4%, which is in line with the numbers they gave us in this most recent report. In fact, over the past quarter, they grew annual recurring revenue at 5.2% per quarter, and over the past year, it's been growing at 20.3%. If there is one negative when I look at this, it's the fact that over the past 4 quarters, receipts have gone sideways. So that could be just a temporary thing, and maybe the next few quarters we'll see it take off again. But when I compare the price to sales ratio of about 7.7 with this sort of growth rate, I think that this sort of growth rate does justify the valuation. Now, the only problem is whether there's going to be a sell-off in the tech sector over the next few years. That's probably the only problem I have. A nice steady growth rate here at 4% per quarter. If they can continue that, a valuation of around $350 million is not too stretched at this point in time. And finally, last thing for Whisper, I'll show you the weekly chart for this company. They IPO'd in the middle of 2019, and from the IPO to the start of 2020, the share price just went sideways. And then during the COVID-19 financial panic, the share price went below $1 for a brief period of time. And in hindsight, that would have been the perfect time to buy into this company, because over the next 5 months, the share price ran from just below $1 to a high of $5. A nice little 5-bagger for anyone who bought at the low and then sold at the high, but everything's in hindsight. Not many people would have done that. And then ever since the highs, looks like the twin highs of around $5 in August, September of last year, the share price has been drifting down or going sideways. And in fact, every single time the share price gets towards $3, there's a little bit of buying comes into the market. So $3 looks like a good area of support. So if the share price falls below $3, that would be quite bearish. You could even argue that buying into Whisper at around $3.10 would be a low risk buy, because if it falls below $3, you would sell out, so you wouldn't lose much capital at that point in time. So I'm not following the company all that closely. If the share price moved below $3, I'd actually transition this to my turnaround watch list. And the main thing I'm waiting for with Whisper is some good news in regards to their future operations. That's all for this video on Whisper. If you are a shareholder of this company and have some questions for me, or if you think I'm a complete idiot for selling out of the company, make sure you leave a comment, a constructive comment, not a destructive one, because destructive comments help nobody. So I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Talk to you later. Bye.